Welcome to Spring into ETF Investing, a special edition of ETF Market Insights. On today's special episode, we will be discussing an evidence-based approach to investing, asset allocation ETFs.
Welcome back to ETF Market Insights and our special Spring into ETF series. I'm Erin Allen with BMO ETFs, and I'm here today chatting with Dr. Mark Soth, also known as the Loonie Doctor. Dr. Soth is currently an associate professor in the Department of Medicine at McMaster University and has a recognized passion for education, winning him numerous awards in the field for his teachings. He's now shifted his focus to deliver a curriculum to improve financial health for Canadian professionals through his blog, The Loonie Doctor, and as the host of the Money Scope podcast. Welcome, Mark. Thanks for joining me today.
Great. Well, thank you for having me.
Yeah, I'd love to get into it and talk about asset allocation ETFs. And we've talked a lot about how this is really an evidence-based approach to investing. And I want to go through some of that evidence with you today. So maybe we'll start with the most obvious part around asset allocation and the importance of thinking about your asset allocation. Walk us through the evidence around why this is one of the most important decisions when it comes to our investment portfolios.
Yeah, sure. So first thing is, what is asset allocation? Basically, it's the proportion of the different holdings that you have in your portfolio. So if you think of that at the highest level, it could be your percentage of stocks versus your percentage of bonds, but you can even slice and dice it further and have stocks and bonds from around the world or in different areas and industries. There's lots of ways to do that. But however you do that, this is actually one of the most important decisions that you make within your investing journey. And there is good evidence to show that. So it is no accident that one of the features of asset allocation ETFs is that they come in different flavors with, different allocations to stocks versus bonds, because at that high level decision is probably the biggest decision that you make. And there is lots of evidence to show how that affects your expected returns over time. So as investors, we expect that when we take risks, that we're going to get compensated for taking those risks with a higher return. And if you look at data, and there's data sets, like from 1925 to 2015, if you just look at the US data, a very low risk or no risk investment like US treasuries that are short term basically pace inflation. But if you take higher risk, like with US large cap equities, the average return over that period was about 7% a year. And if you risk your money in smaller stocks, 9% a year. So there's this relationship between taking risk and getting the return that you get. So choosing an asset allocation that has a mix of those risky things like stocks versus bonds helps you to get your investment returns. And you want to be able to choose an asset allocation out of those different flavors, which the asset allocation ETFs have, like 100% equity or 80%, 20% stocks to bonds. That allows you to take as much risk as you can, but having enough bonds to stabilize that.
A lot of people think like picking your stocks or timing the market is the most important thing. But really, there's studies that show that asset allocation is the number one determinant, correct?
Right, yes. And this is not actually new information. I mean, there was a couple seminal papers back in 1986 and 1990 by Bessinger, Hood, and Biebauer.
Yeah, that's a mouthful.
Yeah, and what they did is they actually looked at large U.S. pension funds, which are big investment funds. They were able to look at the details of their holdings and their returns. And what they found is that over 90% of their returns was explained by the asset allocation.
Right.
Less than 10% of the returns was explained by market timing and that sort of thing. So asset allocation is the dominant decision that determines your returns. And there was another piece of information from those studies, which has been shown over time, and that is that if you looked at the returns of those funds, it was about 9% per year over that study period. And you looked at the returns of if they had just had those asset allocations with no fees or market timing, the return was about 10%. And if you look at what the fees and costs for running those funds were, it was 1%. So literally the difference between just a buy and hold of all the asset allocation versus what they actually realized was actually the fees. So fees are important too. So asset allocation and fees are major decisions to make, and asset allocation ETFs do the asset allocation for you and have low fee.
Absolutely. Asset allocation ETFs are also by nature quite diversified. They hold a basket of 6 or 7 ETFs as the underlying, which gives you exposure to hundreds, if not thousands, of actual securities. Walk us through, we always hear diversification is the only free lunch in investing, but what evidence is there to suggest that this approach can be fruitful over time?
Yeah, so when I say taking, we take risks and expect returns for that. It's not just about taking any risks. You can take risks that you're not going to get compensated for. You don't want to be taking those types of risks. You want to take risks that you can expect to have a return for that. That's what we would do as logical investors. And when I mentioned that data set of 90 years of US history, there's 2 important points about that data set. One, it was 90 years, so it was a longer time frame that you have with that investing. And the second point is that it was with broad markets. It wasn't just picking few stocks here and there. It was being very diversified over a long time frame. And because equities have uncertainty associated with them, there's a premium that we'd expect as investors for investing. And that's what gets priced in by the markets. So the markets take all the known information about the future and the probabilities and the different narratives that are out there and prices that into the current price. So that when you buy the equity, due to that unknown future, you expect to have a premium, and that's a compensated risk. But if you were to try to pick a few stocks here and there, that is taking specific risks. So something could happen to that one company and torpedo it, and you actually can't predict when those risks happen because they're idiosyncratic by nature. So it's unpredictable future, which therefore does not get priced in and is not compensated. So you want to avoid taking uncompensated risk. And you do that by diversifying. So you buy all of the stocks in the market, and then you're going to get that premium, but you're mitigating that uncompensated risk at the same time. And so that's the other part. We talked about market timing not being as important as asset allocation, but diversification helps to get rewarded for the risks that you're taking. And that's very important because if you think, okay, well, I'm just going to pick the winners and avoid the losers, then I'm going to do better than the average. And if you look at the data, there's professionals who are well-resourced, expert at what they do full-time, and over 90% of them cannot actually stock pick and beat the market. And there's good reasons for that. There's a paradox of skill where they're all equally skilled and competing with each other, and the opportunities are small and fleeting, so they're all equally awesome. And if you look just statistically, if you were to just randomly try to pick stocks, and this is another piece of evidence, there was a paper called Do Stocks Outperform Treasury Bills? And it was published in 2020. And Treasury bills, as I mentioned, are basically a risk-free investment, roughly track inflation. But if you look at stocks over a long period of time, 58% of them basically underperformed a risk-free U.S. Treasury. So if you to randomly pick, you'd be more often to pick, like picking something that's actually going to underperform. And if you look at what caused the market returns, only about 0.3% of stocks, like 80-something firms out of the 26,000 that they looked at, accounted for beating the market and generating the wealth. So if you're going to think you're going to pick the 0.3%, good luck. Yeah. And the problem is you have to pick that 0.3% before they become successful. Right. After a company has become part of the big successful companies, their forward-moving returns are actually often quite lower.
You need a crystal ball, in effect.
Effectively, yeah. Crystal ball and to be lucky. So that's why diversification gets around.
Yeah, and I think you mentioned the SPIVA research, and we've talked a lot about that on the channel, but I think it's just, so important looking at those long-term time horizons, how indexes, have tended to outperform active over time, and that diversified approach has really won out. So it's very interesting.
Yeah, there's a logical reason behind it.
Mm-hmm. So that diversification across the globe definitely sets us up to talk about some of the biases that investors have when it comes to investing. And probably the most talked about is the home country bias here in Canada. So talk to us about how asset allocation ETFs kind of overcome that for investors.
Yeah, well, first it's important to understand what home country bias is. And, it's not just a Canadian thing, it's all over the place. It's just that the issue is Canada actually has a small weighting in the global market. So if you looked in 2023, it was about 3%. But if you looked at what Canadian investors were investing in, we have way more than 3%. It was actually the average allocation for a Canadian investor was about 52% to Canada. So much, much more than our market weighting. And that's so that we have this bias towards our home country. And this is a well-recognized thing, and there's actually good reasons behind it and bad reasons behind it. So Bad reasons behind it would be that we're just familiar with Canadian holdings and we just don't understand what's out there beyond Canada. That would be a bad reason. But there are good reasons for it. So one of the good reasons is that a bit of home country bias hedges us against the lifestyles of our neighbors. So if Canada's doing super fantastic and we don't have a bit of extra Canada, we're going to see everybody else around us doing really well, and it's not a good feeling.
True, yeah.
So having a bit of hedging towards how we compare ourselves to people around us is important. With Canadian eligible dividends, there's also a tax credit. So when the dividends are paid out on a dollar for dollar basis, they're taxed more lightly than foreign dividends are. But you have to be careful with that because it may also be that foreign companies pay lower dividends and instead you get that return back as a capital gain at some point, which has tax deferral and potentially a lower tax rate too. So it's not a slam dunk, but it is attractive to people, and people understand income, so it's attractive to them. The other thing that you can consider is that, we have an equity market which has risk. Other foreign markets have equity risk as well, and they tend to be correlated, but they're not perfectly correlated. So if you have different assets that are not perfectly correlated and move up and down at different times, but have a similar expected return, and you can diversify using those and actually decrease the volatility because they're moving up and down at different times, but because they have similar risk levels, over time, you should expect to get the same risk. And that's the so-called free lunch in investing. And if you look at Canada versus the other markets, historically, holding somewhere between 20 to 40% Canadian allocation lowers that volatility without lowering the risk much. So it's no accident that the asset allocation ETFs have a slightly higher home country bias to Canada, somewhere in that 20 to 40% range. Historically, that's worked. We don't know if that'll work in the future, but there's thought behind this. It's not just a random decision.
Absolutely. Great answer. I think that sets us up to talk about other biases that investors have when it comes to their portfolios, things like recency bias or, just becoming emotionally attached to their holdings. How do the asset allocation ETFs help with that aspect?
Right. So let's say you've taken the time and you set your asset allocation. Well, that's not going to stay that way. Some things will go up at different times and down at different times to each other. And that asset allocation that you've set, it's going to drift off as some things do really well and other areas of the markets lag. And what you need to do to avoid having that concentrated specific risk that you don't get paid for is rebalance. So you'd have to trim some of the holdings that have done really well to buy some of the holdings that have done less well. So it essentially forces you to sell things while they're high, buy things while they're low in a way, and manages that risk that you can get from over concentrating. So an asset allocation ETF does that mechanically, which is really important because even if you know that's what you should do and you feel like you're disciplined and going to do it, we have a lot of human biases that prevent us from actually doing it. It actually makes it really hard. And one of those that you mentioned is the recency bias. And you don't even have to look far to see an example of recency bias. I remember just last year, everyone was talking about the S&P 500 because the S&P 500 had a couple of fantastic years. If you look back 15 years or so, it had actually done better than most other markets, especially non-North American developed markets. And people were saying, well, why don't you just don't bother investing in non-North American developed markets, just buy the S&P 500.
Yeah, I see that all the time.
Yeah, and you're going to do great. But if you look over longer periods of time, like multi-decade data sets, you see that actually leadership changes around the world between different markets. And even that recent, 2 to 15 year period isn't long enough to understand that. And if you look at what's happened so far this year, non-North American developed markets are up by about 10% and the S&P 500 is down by about 5%. And if you had rebalanced, you would have bought more of the non-North American markets and rode that up and trimmed some of the S&P 500 before it dropped. So it helps to manage that risk. That's the biggest issue of managing the overcompensation risk. But it helps you to take advantage of, the equity premium over time, but not not getting that uncompensated risk from over concentrating. So the recency bias is very hard to fight.
Yeah, I think it saves investors a lot of time too, right? Like even if you are emotionally equipped to rebalance at the right moments,
Yeah.
you still have to spend the time doing that. So these things make it a lot more convenient for investors.
Yeah, absolutely.
Fear and excitement makes us do, oftentimes bad things at, bad things at
the
bad
worst
times.
possible time, yeah.
So talk to us a bit more about that sort of behavioral gap.
Right. So the behavioral gap. So if we were to buy an investment and robotically hold it over time and rebalance it, we'd get a return. But the returns that investors realize in real life tend to be different from that, because as I mentioned, we're wired to buy things when they're popular and expensive and sell things when they're unpopular and cheaper. So which is the opposite of what you do, but that's how we are wired. So we tend to buy things and sell things at bad times. And if you look at that money flow of when we buy and sell things, which is basically market timing, that we actually, even using a fund, you may underperform the fund if you're timing when you buy and sell that fund. And there is evidence to back up that this is actually an important phenomenon, actually have a pretty profound impact on your returns.
Right.
Morningstar does the Mind the Gap report every year, where they look at that fund performance versus what investors get in real life, because when they buy and sell, and there's a gap there, which they call the behavioral gap, and it averages about 1 or 2% a year when you look at all holdings together.
That
but
compounds over time.
Oh yeah, that's huge over time. If you think that 1 or 2%, that's like, what we talk about saving fees for mutual funds versus ETFs. It's a big impact.
Right.
So it is actually very important. And the other thing that they do with their data is they break it down and they look at it for different fund types. So if you look at more volatile, exciting funds that may have stories with them, so sector funds tend to have the worst behavioral gap.
And that type of thing.
Yeah, a sector fund will have the worst behavioral gap because people are using those to invest some investment thesis or how they feel about something or someone's outlook. But you have to remember that's priced into the market. And the thing that piques our emotions the most, besides just having a story to go with it, is the volatility. The more the price goes up and down, the more it piques our emotions to buy and sell things at bad times. So if you look at the most volatile sector ETFs, that's where the behavioral gap is the largest. It can be around 4% on average. So,
interesting.
But the part about asset allocation ETFs is interesting, because on the other end of the spectrum, if you look at the lowest behavioral gap, it's with asset allocation ETFs that rebalance for you. It's about 0.5% a year. That's pretty small.
That's good evidence.
Yeah, it is good evidence. They just this past year in 2024 came out with another way of looking at it too. They actually looked at ETFs and they looked at mutual funds, and the behavioral gap for asset allocation ETFs was a bit higher. It was like about 1.5%, whereas with the mutual funds is about 0.5%. But the data is pretty limited with that, and the issue is that with the data is largely driven by the big mutual fund type target-based funds in the US, where people automatically buy into it with every paycheck.
Okay.
So that automation kind of gets around market timing completely. So the message I take from that, and we'll see that story unfold over time, is that ETFs are a fantastic tool, and an asset allocation ETF is a great tool for all the reasons that we've talked about, and has the potential to reduce the behavioral gap. And of course, it saves in fees compared to mutual funds. So even if they were convenient, the cost is more. But like every tool, you can use it well, or you can actually not use it well and not get the benefit from it. So you want to be buying your asset allocation ETF regularly, whenever you have money, and not use it as a market timing tool about when you buy your asset allocation ETF.
Yeah, good points. And you mentioned fees, and you mentioned fees earlier as well. And I think that's a really important point about these asset allocation ETFs. But talk to us about how saving in fees over time can help us reach our goals faster.
Sure. So we've talked small numbers, 1 or 2% here per year. It sounds like nothing. But when you have that added into compounding, it makes a big difference. And we've talked about fees, we've talked about behavioral gap. The other thing that's buried in funds is taxes. And one thing about the asset allocation ETFs is they have been built with tax efficiency in mind. So the way that they hold the different stocks from around the world, they do that in a way to try to minimize the foreign withholding taxes that are buried in there. And the other thing that can happen if you have a more actively managed fund is there's turnover. And when you have a lot of turnover of the investments within the fund, that triggers taxes. And no, it's hard for people to quantify that with a study because taxes are so variable and situation specific, but taxes are predictable. And for a lot of Canadians, they're important because we may end up paying a lot of tax. So fees, taxes, behavioral gap, all on their own may seem like small numbers, but they add up to a big number. And the nature of compounding is that it's not a linear growth, and it's an exponential growth. And that's why it's so hard for us to understand as humans, because we think linearly. So if I say have a 1.5% per year higher cost of investing from all those things, using a mutual fund versus an asset allocation ETF, after 10 years, that's not a 15% difference in the amount of my money. It's about a 29% difference in the amount of money they have because of that compounding. And if you look out over a couple of decades, it could be that your portfolio is only 2/3 the size of what it could have been if you had saved on the opportunity costs that you lose from those fees and behaviors. So compounds over time. And you think maybe, well, 2 decades is a long time, but
that
actually
should be most of people's time horizons.
Yeah.
Right?
Well, I mean, our time horizons is really actually our lifespan. Most of us don't go and sell our entire portfolio on the first day that we retire. We will use it over time, and it's our lifetime that is our time frame. And hopefully that's many, many decades. And you can imagine the effect of compounding over that would be ginormous.
Yeah, for sure. And asset allocation ETFs, they adopt a strategic approach to asset allocation, one that doesn't change a lot over time and one that is aligned with different risk profiles. Everybody has their unique goals and objectives. So walk us through a bit more about how asset allocation ETFs can help with that side of things, like developing a more strategic approach.
Yeah, so there's a nuance in there. I mean, the implication is that you may change your asset allocation at some time. And what do you do if you got an asset allocation ETF? A couple of points to make about that. One is that, it is okay to change your asset allocation over time. The key is that you're changing it because your situation has changed. So your ability, willingness, or need to take risk has changed. So the asset allocation that suits that has changed. You don't want to be changing your asset allocation in a reactive way to what's happening in markets or what you think is going to happen in the future with markets. It should be because of your situation. So just to give the most common example that comes up with that is, as people approach retirement, they're thinking about should they change their asset allocation to have a bit more fixed income or some stability, even for a few years to help them get used to that change of having had earned income to be having income and drawing money from your portfolio. It's psychologically very different. I mean, there's a mathematical argument to staying invested as aggressively as you can throughout your entire lifespan, actually. But from a psychological standpoint, that's very difficult, especially when you have a change in your income stability. Yeah. So there may be reasons to make changes to your asset allocation. You can do that with an asset allocation ETF by adding new money to a different asset allocation ETF that perhaps has a bit more of a fixed income component.
Yeah, that's a good point. It doesn't mean selling your ZEQT and moving into ZGROW. You can go a little bit more conservative to balance it out.
That's right. Yeah, you can do that. Or if you want to go faster, you could just start adding a bond ETF on its own.
Yep.
You could sell some and buy some of the other, but that's going to be a bit more. We're always reluctant to sell things. Mm-hmm. And I actually see that as a feature, because the second point I wanted to make about changing your asset allocation over time is that it's like steering a ship. You'd want to make proactive, gentle, nudging changes as your situation is changing. You don't want to make a sharp, reactive change and zigzag all over the place and have a wipeout because of it. And having a bit of a disincentive to sell your ETFs is a good thing.
That's great. Thanks, Mark. That was a great overview of all the evidence supporting asset allocation ETFs. And I think just the fact that there's so many options for investors is really a powerful tool, from conservative, balanced, growth, all equity. We even have retirement options with a T series for those who want to start drawing cash flow from their asset allocation ETFs, like ZBAL.T, for example. So lots of options and flexibility for investors. If you do want to learn more about asset allocation ETFs, you can go to our website, but also check out Dr. Mark Soth's website, the Loonie Doctor, where he's got a few great articles on the subject as well. So thanks again for joining me, Mark.
Great, and thank you for having me.
We'll see you next time.